as you started off by saying, our psychology has been set in place by billions of years of evolution. We are not going to be able to change the way we think, even if, despite whatever our best interest is, our best efforts are. The reality is that we are hardwired to react in a certain way, and which is why over the last 20-30 years, behavioral finance is sort of one of the fastest sort of emerging field within finance. And clearly, there are a few rules of thumbs that we can take to sort of protect ourselves. And for example, something like SIP, why is it so brilliant? Because it automates the decision of putting money every month, and it sort of separates that, because every time you take the actual decision of investing, there is always an element of regret that can come in, because if you invest today and the market falls tomorrow, then you sort of start questioning yourself, saying, did I act too soon? Was I wrong in my decision? And the minute you sort of automate that decision, and you let it happen automatically at the back end on a every month basis without really, then you're separating the emotion from the action, and that allows you to be a little bit better and more comfortable about it. So that's maybe one way, which is to sort of automate as much as possible, systematize as much as possible. That's one thing. The second is sort of to not look too often. It's really tempting to look at one and started investing, especially when markets are doing well, to go back and check every day how the NAVs are, check every week what is happening to our investments. Reality is that if we have invested for the long term, daily, weekly changes are not really going to have a very material difference to the overall plan. So have that discipline that the review should be periodic, review should not be too often, because then it sort of also forces the itch on us that we should take some action every time we keep looking at it, because it just keeps impacting us more. So that's something. And the third, maybe I would say finally, is that maybe have a pre-agreed plan. So when we are investing, you have a pre-agreed plan that what will I do if the market goes up 20%? What will I do if the market goes down 20%? If we have thought about this in advance, then we are not struggling when the market actually prices us. And then we are not taking decisions completely emotionally, because when we think about this in advance, we can be a little bit more rational. Sitting today in April 21 to say that over the next 6 months, what will be my plan of action if in this year, if the market corrects 20% plus? Will I add? Will I do not add? Think about it today without any emotional baggage, and write it down saying this will be what my plan is, so that when the market does that, you can at least revisit that, and it allows you to have some sense of balance rather than completely reacting in an emotional manner to that event.
Ashwin, just to close out this conversation now, and my question here is to one of the points that you raised, which is to automate and which is to have periodic checks. Now, the question here is to say that if you look at 2020 and the kind of gyrations that you saw, I would actually think that if you had a predetermined asset allocation in your portfolio and said that you have 60% allocated towards equity and 40% towards debt, if it suddenly moved to a 40-60 on the other side because equity has crashed so dramatically, do you move then? And in a situation where you're seeing humongous volatility, do you reduce or scrunch up the kind of periods that you check that allocation?
So definitely, if there are such a dramatic happenings, dramatic situations playing out in the market, you have to keep track of them. It's one thing to say that don't look at the market on a daily basis on a 2-3% move, and quite something else when the equity market suddenly falls 30%, 40% over a month. That's obviously something that will require everyone to just take stock in terms of what has happened. And which is where I feel that if you had set certain things, that will allow you to take sort of cool-headed decisions on what is to be done. You said it perfectly right. For example, if you have an asset allocation target, 60-40, 50-50, whatever it is, and you plan in advance saying that market falls down, then typically my asset allocation will get skewed. So therefore, I'll need to move some of my debt allocation into equity to get it rebalanced. Then if you've thought this thing through in the cool times, then when this happens, it makes it easier for you to decide, okay, this is what I had planned. Why not I try and check what has happened, and allows us investors to take the decision. So absolutely, yes, big dramatic moves in the market cannot and should not be ignored. People should take stock, but ideally they should avoid taking decisions purely reacting to the emotional impact of those moves, because that really will be damaging.